How's everyone doing tonight? You are in the strategy room with your host, the banker next door, Dr. Joe Berquist. So this is Saturday night, November 29th, 2025. I hope everybody had a great Turkey Day, great Thanksgiving week, as it were. So have the usual show tonight, but a little bit different in this, I guess, in the sense that I don't quite have as much information with Thanksgiving week being a slower week as it normally is every year, but still have a lot of great information to talk about tonight. I've got a lot of Fed news we're going to talk about as far as the potential December rate cut. Will or will that not happen? We're going to talk about Jeremy Powell's future. Have they picked the next Fed chairman? We'll talk about that. We're going to talk a little bit about tariff information, give a little bit of a Doge update. I've got a lot of banking news with a lot of different things coming to talk about. We got CFPB update. We got open banking update. A couple different things I want to hit on. We're going to talk a little bit about retail sales, given how important retail sales are with Black Friday and everything that usually goes on in the retail world. So we're going to talk about that a little bit later tonight. But first things first, I'm going to kick us off as I normally do, checking out the debt clock. Now, you might notice something, a keen observer might notice something different this week. They have removed, if you look at the top right-hand corner here, they have removed our Doge clock. Our Doge clock is gone. I actually looked all over the page to see if they maybe had moved it to a different section, and they did not. Now, why did they potentially do this? Well, there was a lot of news reporting at the beginning of the week that Doge was basically dead, that Doge was dead and going away, that they had closed up shop. That turned out to be false reporting. As I'll talk here, like we'll go into this article here, White House denies reports that Doge doesn't exist anymore, says the agency has no centralized leadership. So the statement on Doge came in response to a report claiming that it didn't exist any longer. So the White House on Monday responded to reports that the Department of Government Efficiency, Doge, established under President Donald Trump, was effectively ended, with the head of the White House's human resources arm saying that it is not under centralized management. A report from Reuters over the weekend, this is last weekend, included a quote from the Office of Personnel Management Director Scott Cooper, or Kapoor, if I'm saying that right, that Doge doesn't exist with 8 months left to go before it's officially disbanded. A White House official told the Epoch Times on Monday that Doge has always been integrated throughout various federal agencies and that such efforts to reduce fraud, waste, and abuse will continue. In a post on X on Sunday, Kapoor disputed the Reuters headline that Doge is non-existent and suggested it was misleading. The article, he wrote, had crafty editing and spliced my full comments across paragraphs to create a grabbing headline. The truth is, Doge may not have centralized leadership under the United States Digital Services, he stated, but the principles of Doge remain alive and well: deregulation, eliminating fraud, waste, and abuse, reshaping the federal workforce, making efficiency a first-class citizen, etc. Doge catalyzed these changes inside agencies, along with the Office of Personnel Management and Office of Management and Budget, he said. Kapoor in his post also included a November 21st OPM news release that stressed the federal government is focused on maximum efficiency in terms of hiring and firing staff. So Doge is not dead. Doge is still around. Matter of fact, there was actually some posts in the last few days from Doge, basically just talking about some of the contracts that they had eliminated this week, and basically kind of poking fun at this whole thing, just saying, hey, we're still here, haven't left, haven't gone away. But what I would say, and what I would really love to see, I have always been a fan of Doge. I love the concept of Doge. This is something that needs to become a permanent part of the federal government. There needs to be, again, Congress needs to do their job. They do, it says here, the agency has no centralized leadership. Well, that should change. That should absolutely change. Somebody should be appointed as the spokesperson for Doge. Doge should be doing weekly press conferences for, they don't have to do long press conferences, but, do a half-hour press conference, talk about the contracts you reviewed, talk about the different departments you reviewed, talk about the audits, talk about things that you found, talk about the waste, fraud, and abuse that you're finding. And regardless of how big or small it is, every week you basically point out that, hey, we found this, hey, we found that. And why would I want to see that? I want to see that because that is what will lead to change. That is what will lead to further conversations, because eventually they will start coming out with a few barn burners here and there. They will start coming out with a few things that will catch people's attention and say, whoa, wait a minute, what's going on over there? Um, for example, Elon Musk was just on Joe Rogan's podcast, and he gave one of the examples that he was talking with one of the senators. They had given $12 billion to the Navy on a contract, and to build ships, and I think repair ships, do some other things, and basically nobody could figure out what happened to the $12 billion. It's like, where'd the $12 billion go? Nobody knew. Nobody had any answer. Not a ship was built. Not a ship was repaired. Not a ship was renovated. Just $12 billion just disappeared, just like that. And that's a perfect example of the kind of stuff that Doge should be looking at and should be coming out with, to basically say, hey, maybe a problem here. We need to do something here. So I would love to see Congress make Doge a permanent agency and put somebody as the head of that agency, and basically have Doge become and remain much more active in terms of coming out and talking about what they're doing. Obviously, the swamp does not want that. This is why the swamp pushed Elon out. This is why the swamp, to a very large extent, has sidelined Doge. And they would love nothing more than for Doge to just go away, because they don't want Doge pointing out all of their corruption and all their fraud and abuse. They don't want that. So, but anyway, I just wanted to point out that, Doge is still there. It got removed by, off of the debt clock, but they haven't gone away, at least not yet. But we'll see what happens there. But anyway, but get back to the debt clock for just a second here. A couple things I just wanted to point out here. So while they took the Doge clock away, they did replace it with something that I think is even really good: tariff revenue. So we're up to $369 billion in tariff revenue this year, which is an absolutely incredible increase from where we were. I mean, last year, I think tariff revenue was, it might have been as low as like $8 or $9 or $10 billion. I mean, it was next to nothing. And then the revenue. So what does that equate to in terms of revenue per taxpayer? That's $3,247 per taxpayer. So again, fantastic. Love to see it. Now we'll talk a little bit more later about the whole, $2,000 checks. Should or do we want to just give this? I am not in favor of that. I do not want the money gone. I wanted this money to come in, to be extra money that would come in so that the Republicans could reduce taxes, so that they could cut taxes, and that any of the other politicians that basically cried about, well, you can't cut these taxes because we have to replace the revenue. Well, here's the revenue. We're going to bring in all this tariff revenue. That's going to enable you to reduce taxes. They had also talked about potentially reducing or eliminating income tax, and how they would do that was by having the tariff revenue replace it. That's what I'm in favor of. Or even better, how about we take this tariff revenue and how about we put it toward eliminating some of our national debt? How about, here's a novel approach. How about we start to pay down the national debt with some of this money? Considering the fact that we're only $38 trillion in debt, and we only have a $1.7 trillion federal budget deficit, and our debt to GDP is only 121%. Maybe we need to start doing something to address that. That might be a good idea at some point, right? Some other interesting numbers on here to point out. So, largest budget items: Medicare and Medicaid, $1.7 trillion. Social Security, $1.6 trillion. Defense war spending, $928 billion, almost $1 trillion on defense spending. Interest on the debt, we paid $968 billion just to service the interest on that $38 trillion in national debt. So it's costing us almost $1 trillion a year just to cover the interest on the national debt. I mean, that's crazy. So just so everybody understands, we're spending more now on the interest on the national debt than we are on our defense spending. Our defense spending is absolutely ludicrous at $928 billion. I can tell you right now, the waste, fraud, and abuse in that defense spending is off the charts. But of course, they wouldn't let Doge get in there. They kicked Doge out before that was allowed to happen. But again, the fact that we're spending more on interest just to service the national debt than we are on defense spending is just that in and of itself is crazy. So, okay, so like I said, just some numbers on here that I wanted to point out. I like looking at this from time to time. Okay, let's talk about tariffs for a second. We just pointed out tariff revenue in the chart there, but let's look at this for a second. So Trump says tariff revenues will skyrocket as pre-tariff stockpiles run out. So tariff income is expected to surge as inventories of goods bought before the levies kicked in are depleted and importers face the full weight of trade policies. So President Donald Trump said over the weekend, and again, this is last weekend, said over the weekend that tariff revenues are poised to skyrocket as global buyers exhaust stockpiles of untariffed goods, clearing the way for what he described as record-setting inflows to the U.S. Treasury and a new era of national security and wealth. In a November 23rd post on Truth Social, Trump said foreign importers had stocked up on large quantities of goods ahead of tariff implementations to delay paying duties. That front loading, he said, created a temporary lag in the full revenue effect of his global tariff regime. That heavy inventory purchase is now, however, wearing thin, Trump wrote, adding that once pre-tariff supplies run out, tariffs will be paid on everything they apply to without avoidance, and the amounts payable to the U.S. will skyrocket over and above the already historic levels of dollars received. He said the payments will be record-setting and put our nation on a new and unprecedented course, adding that the power of tariffs will bring national security and wealth, the likes of which has never been seen before. Now, we'll see. The United States has collected nearly $320 billion in customs and excise taxes so far this year, compared with roughly $170 billion at the same point in 2024, according to the Penn-Wharton budget model, which is based on Treasury data. Yeah, I really don't think that they collected anywhere near $170 billion for 2024. I could be wrong. On that, but again, numbers that I looked at, I don't remember seeing it being anywhere near that high for 2024. But anyway, but let's on face value, let's say they're right. Okay, but still collecting $320 billion so far as per this number, but as per the debt clock, it's $369 billion. But okay. But the Tax Policy Center estimates that Trump's 2020 tariff actions have lifted the average U.S. tariff rate to 17.6%, with revenue projected to total about $2.3 trillion from 2026 to 2035. The group estimates that the tariffs will add roughly $256 billion to federal receipts next year and increase the average household cost by about $2,200. The group cautions that its figures are highly uncertain as they reflect complex stacking rules and do not include the impact of foreign countermeasures or broader macroeconomic impacts on the U.S. economy. Okay, now here's where I say take a time out for a second, because here's what is going to happen if all these tariffs and everything again remain in place. But again, this would, you have to assume. Again, if you're going out to 2035, you would have to assume that other Republicans come in and hold the presidency and that they basically continue Trump's trade policies. You also have to assume that a Democrat who comes in wouldn't be dumb enough to kill a golden goose when they have one. So you have to kind of assume that off the bat. I don't know that would be true. I don't know that we'll see that happen. But say that this does carry out. I do believe that the tariffs will diminish over time, because remember, if a company builds the product in the U.S., how much tariff do they pay? They pay zero. So that's going to hurt these numbers a little bit over time if this is kept in place. Like, I think if this is kept in place, it will do amazing things for our economy over time, because number one, it will bring in more revenue from anybody overseas, Europe, Asia, China, whoever, that want to bring their product into the market. They will have to pay more to bring it in. It's a good thing. Secondly, it will cause a lot of companies to move manufacturing back to the U.S. so that they will not have to pay the tariffs. So that will gradually reduce that number somewhat over time, if that comes to be. So again, there's a lot of what ifs in this right now, but if this works, at least in the short run, we're going to see a lot of tariff revenue coming in. Scott Bessent said earlier this year he could see it get up to as much as $500 or $600 billion in tariff revenue. That could be possible next year. Next year, that could absolutely be possible. We will see what we'll see what happens with that. But let's look at a different aspect of this. So we analyzed 5,000 calls to find out what CEOs really think about tariffs. So Trump's trade war is a pain, but less so than many executives expected. So this chart was kind of interesting. So this is the sentiment of executives' comments on tariffs during earnings calls. So basically, in other words, how much were they really mentioning tariffs? And you can see here that basically for the blue line would be more positive. The yellow line here is more negative. But you can see here that it's really, just recently it spiked up into much more positive territory. And even the negative wasn't really that negative over the last, 5 or 6 months. I mean, basically in here, the fourth quarter, third quarter, a little bit more so, but, fourth quarter, it has definitely waned. And so what does it say here? Business leaders are sounding less gloomy about tariffs, which are coming up less often in earnings calls. Executives are starting to chill out about tariffs after a year of anxiety. Months into President Donald Trump's roller coaster of a global trade war, something has shifted. Business leaders sound less gloomy about tariffs than they have been for much of the year. They are talking less about risk when they discuss them with investors, and the subject is no longer dominating earnings calls like before earlier in the year. We believe that the worst of the tariff and economic disruptions to our businesses are now behind us, says David Marr, chief executive of Spectrum Brands, which sells everything from pet food to insect repellent, on a call with investors this month. And for good reason. The real tariffs companies pay have turned out to be lower than the headline figures. Companies paid about 12% of the value of their imports as tariffs in October, consulting firm Oxford Economics estimates. That is about 10 percentage points higher than in January, but well below the most dramatic rates announced by the administration over the course of the year. The U.S. has, meanwhile, hammered out new trade agreements, and Supreme Court justices earlier this month questioned Trump's authority to slap levies on nearly every country on earth. Companies have also gotten better at mitigating the costs, securing exemptions, raising prices, cutting spending, and rearranging supply chains. The affordability crunch on voters' minds could lead to further relief ahead of next year's midterm elections. Trump dropped 40% tariffs on certain agricultural and food products from Brazil this past week. That is on top of the previous week's rollback of duties on beef, coffee, and dozens of other goods in response to Americans' cost of living concerns. Companies have passed along about 2/3 of tariff costs to consumers so far, excluding food and energy, down from closer to 100% in Trump's first term, said Bernard Yaros, lead U.S. economist for Oxford Economics. Big companies especially had healthy profit margins going into the year and have been able to absorb some of the cost. Now, that's kind of double speak there, and I would highly question that. It said companies have passed along about 2/3 of the tariff cost to consumers, but then a sentence later, they say big companies especially had healthy profit margins going into the year and have been able to absorb some of the cost. Now, I would argue that the companies have actually been absorbing most of that cost up to this point. Actually, a lot of that cost has not as of yet been passed on to consumers. We shall see if that changes over time, but I don't believe that to be the case yet. But anyway, the point of this article is that a lot of CEOs right now are really starting to pull back on their emphasis of tariffs being the issue that could, derail their financials or really hurt the company's profits, hurt the company's earnings. Again, the big boogeyman of the tariffs is really beginning to wane now, as like I said, a lot of these things are beginning to play themselves out. We've seen a lot of the trade deals finalized. We'll see what happens with the Supreme Court. When the Supreme Court does make their final decision on this, which probably won't be, I would imagine, for a few more months. But when it does come down, I mean, obviously that's going to be a monumental, decision on the part of the Supreme Court. We'll see what happens. But again, for the moment, things are starting to chill out at least on the tariff side. So, okay. Let's move on here. Let's see. Bessent says that Americans to see substantial refunds next year and no risk of recession. I am very, very optimistic on 2026. We have set the table for a very strong non-inflationary growth economy, the Treasury Secretary said. So, okay, interesting. So Treasury Secretary Scott Bessent on November 23rd said the government shutdown that ended earlier this month will not create a recession risk for the broader U.S. economy, and that American families would see substantial refunds next year. In an interview with MSNBC, or rather NBC's Meet the Press, Bessent said that while portions of the U.S. economy, such as housing, were in a recession because of elevated interest rates, he did not expect the broader U.S. economy to plunge into recession in the coming months. I am very, very optimistic on 2026. We have set the table for a very strong non-inflationary growth economy. Bessent then cited provisions on the Republican-backed One Big Beautiful Bill. And then let's see here. I wanted to get to the, does he mention the $2,000? No, he doesn't really mention that, at least in this article. So we'll get, like I said, we'll get to the $2,000 checks here a little bit later. Here's what I would say on this, though. Okay, couple of thoughts here on this. There are two major things I think looming over our economy that I've called out. For months and months and months, I've brought a lot of concern around the private credit market. We've seen a number of companies there blow up in the last few months, whether it was First Brands, Tricolor Holdings, PrimaLend. Like we've seen a number of companies there blow up in the private credit market. And I believe that there's going to be more to come on that. That's a wild card. What is the extent, do losses get to a point where that becomes a much bigger issue? Where you have the Fed has to step in, or hedge funds have to be bailed out, whatever, I mean, that I think is a big looming question. The other question is the AI bubble. And like I said, we're going to go through a series of articles here in just a few minutes on AI. I'm going to show you guys exactly what I'm talking about with the AI bubble in terms of all the different aspects, issues with accounting, all the bonds that have been issued from the AI companies, American economy basically getting hooked on the AI spending. So I have huge concerns around that. I have concern, just the AI bubble and the private credit bubble. I have major concerns around those two big issues. I mean, if those things burst, I do not see how it does not plunge us into a recession, but we'll see what happens. With that being said, I think the table has been set for a lot of really good things potentially to happen in 2026. The amount of investment that a lot of companies have pledged into the U.S. is really going to start kicking off next year in 2026. You're going to see a lot of things happening there. You're going to see a lot of companies, I think slowly, but they are going to start to move some manufacturing back to the U.S. That's going to create good jobs. We will, again, I think that the stage is set for a lot of potentially good things economically to happen, but we have, like I said, to kind of wait a little bit to see how some of this stuff unfolds. All right. So let's talk about the Fed here for a few minutes. I got some articles here that I wanted to run through with everybody. So this is really important. And I want to read. Okay, I want to read something real quick before we get into this article, because this was news that this goes right in directly to this. So the Fed is encountering difficulties in encouraging banks to utilize its standing repo facility, the Wall Street Journal reported in this article right here. Although there has been increased usage of the facility in recent weeks, some banks remain hesitant to adopt it more fully, which could hinder the Fed's ability to manage interest rates effectively as it reduces its $6.6 trillion asset portfolio. The report said, yeah, well, the Fed is going to have to stop reducing, because that is a tightening. That is when the Fed is reducing its balance sheet, that is what's called QT. That is quantitative tightening. And that's not helping us at the moment. Okay, it is good. I think in the long run, it's good that the Fed reduces its balance sheet. But in so doing that, you have to understand that there are side effects to that. And it is, like I said, it is a form of tightening rather than easing. So that doesn't help us at the moment. When the Fed is reducing rates, but they're basically reducing their balance sheet, which is a form of tightening, those two things kind of offset each other, which is part of the issue of what's been going on. So, but let's look at this for a second, because I have been talking about this over the last couple of weeks, the importance of the repo market and the overall liquidity that brings to the market. And again, another one of those side effects of the Fed reducing its balance sheet is that they have drained all of the liquidity out of the repo market. And as a result, you're beginning to see these spikes, which I'm going to show you here. Like we have one of the charts here. These are the spikes in the repo market that I've been talking about. We had this really big one on October 29th, which was almost like $50 billion. But but again, we're seeing these spikes here because of the liquidity issue in the market. But let's dive into this for a second. The Federal Reserve is struggling to persuade some banks to use a lending tool designed to improve the central bank's control over short-term money markets. Banks have made more use of the tool called the Standing Repo Facility over the past month, but there are signs some are reluctant to tap it more aggressively, which would make it easier for the Fed to maintain a firm grip on rates as it winds down shrinking its $6.6 trillion asset portfolio. At a recent private meeting, some executives told the New York Fed they worry using the facility would carry a stigma, undermining the tool's purpose as volatility increases. The facility allows banks to convert treasury notes and other ultra-safe securities into cash they can borrow from the Fed overnight. That gives Wall Street firms an alternative to borrowing at higher interest rates in the market for Treasury repurchase agreements, also known as repo, which in theory should help keep market rates from spiking out of alignment with the Fed's goals. Exactly. That's exactly what I'm talking about. So let me read that again. So in theory, should help keep market rates from spiking out of alignment with the Fed's goals. So in other words, they need people to use the repo market. Yet repo rates have spiked on some occasions this fall as the tool is facing another test in the coming days. When the Treasury Department auctions of tens of billions of dollars of new securities will settle. Such fund flows have lifted repo rates in the past. So here, this is just repo and SFR rates. And you can see here, that these rates have basically been coming down as the Fed has been cutting rates here a little bit. Now, and again, the daily SRF usage right here, again, we're seeing these spikes here. So let's get it. But the Fed's recent decision to stop reducing its bond holdings on December 1st should help end the gradual rise in funding pressures. And rate volatility has also eased since the start of November. Still, some analysts fear the repo volatility could become more common if banks don't warm to using the SRF. I think the fact that you've seen some usage is positive, but we've also seen that in its current form, it has some limitations, said Patricia Zobel, head of macroeconomic research at Guggenheim Investments and previously a top market official at the New York Fed. Fed officials and investors pay attention to the repo market in part because banks, hedge funds, and other institutions use it to support positions in the Treasury market. Treasuries, in turn, play a critical role in determining borrowing costs across the economy, along with the prices of a range of financial assets. When repo rates rise meaningfully above the targeted range for the Fed funds rate, the interest rate the Fed officially aims to control, you're undermining monetary policy at that point, says Jan Nevruzzi, an analyst at TD Securities. Standing repo operations are standard monetary policy tools, a Fed spokesman said. As the Fed's main rate ceiling tool, these operations are essential for smooth monetary policy functioning, and eligible counterparties are expected to use the tool as appropriate. So this is the main point that I want to get to. Shameless plug here. The Lords of Easy Money. If you have not read the book by Christopher Leonard, if you've not watched my series, please go watch that series. I literally cover every chapter in the book. I did 21 episodes on that. I also did an interview with Fed Governor Thomas Honig, who was the main character of that book. I did an interview with Thomas after I covered the series, which was fantastic. One of my, I think it is absolutely my most viewed interview. So definitely go check that out if you have not had a chance to look at that, because that gives you the information you need to understand what's going on here. What you have to understand is that back in 2010. The repo facility was seeing a little bit more action, but the repo facility was kind of a quiet little thing in the market. It wasn't this big thing at the center of the market. The Fed took the repo market and put it at the center of market liquidity. And the Fed turned it into this thing. And this is why this paragraph is so important here. Standing repo operations are standard monetary policy tools. So, like I said, the Fed, they took the repo market and put it right at the center of market liquidity and made it a standard monetary policy tool. So, you have to understand, and this is what the Fed did. Now, as the Fed's main rate ceiling tool, these operations are essential for smooth monetary policy functioning, and eligible counterparties are expected to use the tool as appropriate. So, in other words, the Fed tightened, they were reducing their balance sheet. Okay. They made it not attractive. So they sucked the liquidity out of the repo market. Now they've got a problem because now banks don't want to use it. And that's a big problem for them because that is what literally puts liquidity into the market. This is a huge problem for them. They can't have banks basically not using it. And now that the liquidity has dried up, you're seeing these spike ups. Where I think that this article is being a little disingenuous is that, they had this private little meeting, and I don't think the true nature of what has been discussed in that meeting, I don't think that this is a case of this is not um the Fed has a line of credit, basically, a line of credit facility that banks use. And there is a stigma in using that line of credit because, basically, banks can get a little if we're borrowing from the Fed, people get a little jittery. There's a stigma with that. There is not a stigma with repo because repo is basically just a lot of treasuries. You're just doing, easy collateralization. You're making a couple points. They're very, for the most part, very safe and secure transactions. There's not a stigma with using the repo market. So I'm not buying that explanation for what's really happening here. I think that there is something more deeper fundamentally in what I would call the plumbing of the market. Again, because the Fed put this facility at the center of the market, this liquidity issue has now become a massive issue. And again, going back to the Lords of Easy Money, the Fed back in 2018 and 2019, the Fed tried to bring their balance sheet down. And in doing so, they reduced the liquidity in the repo market down to 1.2 trillion. Once they broke through that 1.2 trillion dollar barrier, we basically almost saw a collapse of the repo market. The hedge funds had a basis trade going on there because they also had increased interest rates a couple ticks, had thrown this whole basis trade that hedge funds had been doing through the repo market. Basically caused this basically had the Fed came in and basically bailed out a whole bunch of hedge funds on Wall Street. But then COVID hit, that whole thing got washed away. The Fed obviously ballooned with trillions of dollars onto their balance sheet during COVID. And now, Jeremy Powell has been trying to bring some of that back down. So now we saw that back in 2018 and 2019. So the question was, okay, well, how much liquidity can leave the market? Well, 2018 and 2019 would seem to suggest that once the repo market got below 1.2 trillion, that you could have a problem. Do you know where the repo market is today? It's like $50 billion. Like it's not even, if I forget $1 trillion, it's like $50 billion sitting there. It's like, when I mean they drained this thing, they drained it. This is not good, and this is going to lead to some big issues for the Fed in terms of them trying to control rates. And again, I don't trust Jeremy Powell. I do not trust Jeremy Powell. I think Jeremy Powell has been looking for ways to basically, again, his whole MO this entire year has basically been stick it to Trump. Okay, stick it to Trump. I don't really care if the whole country burns down. I could care less. I'm not going to give Trump a win on anything. Okay, that's basically been his motif throughout the entire year. And with that being his motif, his modus operandi, if you will, that is how I see everything that he does through that lens. I see everything that the Fed does through that lens. And I basically sit there and say, you got to sit there, I think, and think to yourself, has a lot of this stuff been done on purpose? Has this been done on purpose to create these problems in the market, to create this disruption in the market? So I think that is a fair question to ask. So okay, but let's start. So a potentially greater challenge for the SRF is coming at year end, when efforts to clean up balance sheets for financial reports can boost competition for overnight loans. This month, the New York Fed President John Williams met privately with representatives from Wall Street banks to gather feedback on the SRF, part of a long-running effort by Fed officials to encourage more use of the facility. Yeah, he wanted to garner feedback on the SRF. Okay, that's code for, yeah, he basically said, all right, you guys better get your bleep, bleep, bleep in there and start buying. At the meeting, some bank officials told Williams that they were worried that borrowing from the SRF, which becomes public on a two-year delay, would carry a stigma, according to people familiar with the meeting. Yeah, I think that's all nonsense. The same stigma concern has long haunted a different Fed lending tool, the discount window, because it is sometimes used by banks facing crises. That's what I was just talking about a few minutes ago. The discount window is effectively like a line of credit from the bank. Now, that does have a stigma to it, and I've done episodes on that. I've talked about what the discount window is, how it works, how a bank gets a line from the Fed discount window, why that stigma exists. I've done a few episodes on that. So if you're interested in learning more about that, I would say go back and check out some of those episodes that I did on that, explaining that whole thing. But again, I just think that this whole, the SRF there's a stigma with us doing repo. I just think that that's nonsense, and I'm not buying that. Williams has also told that some trading desks are reluctant to borrow from the SRF because it diverts financial resources they can otherwise devote to trading with regular clients. Interesting. Okay, maybe. In September, Michelle Bowman, the Fed's vice chair for supervision, suggested during a talk in New York that the borrowing program should charge a higher interest rate to deter routine usage and prevent the SRF from distorting markets. Some current and former Fed officials heard from market participants who worried the comments would deepen the stigma around the facility. Oh, hey, don't talk common sense, okay? Whatever you do, don't talk common sense. Yeah, Mickey Bowman, she's not wrong. Like, she's not wrong in her comments there. They just the Fed's just like, oh, shh, don't do that, don't say that. It's so ridiculous. Okay, but we are going to keep our eyes on this because, like I said, these spikes, like I view these are not good. These signal to me liquidity issues in the market, and that's not a good sign. So we'll see there. Okay. Fed Chair Powell's allies provide opening for December rate cuts. So a divided committee, missing data, and a whiff of stagflation leave Powell to choose between two paths, each with drawbacks. All right, guys, there's no stagflation. Okay, there's no stagflation. Stagflation is high inflation and high unemployment, okay, which we have neither of at the moment, okay? Yeah, inflation's hanging around 3%. That's not the definition of high inflation. High inflation would be what we just had a few years ago under Biden, when the inflation was, 8, 9%, and in actuality it was much higher than that. It was probably 12 to 15%. But that is high inflation, okay? And high unemployment, remember, average unemployment would be considered a 5% unemployment rate. That's considered you're at average employment. We are well below 5%, at least as per the U3. But we are below that 3% rate, or below that 5% rate. And so when they're talking about high unemployment, you're talking about 10% unemployment. So you're talking about 8, 9% inflation, 10% unemployment, and you just get stuck there. That is stagflation. We don't have any stagflation. I love this stuff that they spew out here. So, but anyway, allies of Federal Reserve Chair Jerome Powell have laid the groundwork for him to push a rate cut through a divided committee at next month's meeting, even though it could draw multiple dissents. The unusual level of division inside the Fed means that, to an even greater degree than usual, the final call rests with Powell. To negotiate these stark divisions, Powell is likely to weigh two approaches, each with drawbacks. The first, cut rates as markets now expect, and use the exquisitively negotiated post-meeting statement to signal a higher bar for further reductions. This cut then hold approach would mirror what Powell did in late 2019 when, like now, 3 cuts met meaningful resistance from his colleagues. This option would also likely trigger objections from officials who don't support any cut, but it could end the soap opera of officials airing their disagreements in public by stitching together a new consensus that further cuts aren't warranted if recent conditions persist. Yeah, there's zero chance of that. Zero chance of that happening. The alternative is to hold rates steady and reassess in January when officials will have more of the employment inflation data that was suspended by a federal government shutdown. But that approach could prolong the public discord for another 7 weeks with no guarantee the additional data will resolve the underlying disagreement. So, yes, I think Jeremy Powell told you at the last meeting he's not cutting rates anymore this year. I am willing to bet that he is not going to cut rates, that he's going to basically say, hey, due to the government shutdown, lack of a lot of data here over the last couple of months, from what we're seeing right now, things haven't really, things haven't really fallen apart. So we're basically going to sit tight. We're not going to do anything this month, and we're going to come back and reassess in January. That is my guess. Obviously, that's not going to make people happy. He has this divided Fed. However, the majority is still on his side in that room. In that FOMC meeting, the majority of people are still on his side. I mean, you have 2 or 3, maybe 4 people that are dissenting, but you still have 7 or 8 that are on his side. So again, Jeremy Powell still has the numbers. So he could still do what he likes. If he wants to cut the rate, he could cut the rate. Nobody, again, that's what Wall Street is expecting him to do. That's what the country wants. That's what everybody and their mother wants him to do. But he's not, like I said, he's not going to do it because Powell's going to do what Powell wants to do. He'd rather see us suffer than do what's right. Because if he wanted to do what's right, he would have been cutting rates a lot more, and he would have been cutting them much earlier this year. So that's just my theory. That's what I think is going to happen. We'll find out in a couple weeks here, but that's my bet, is that he does not cut rates. So we'll see what happens. Bessent said there's a very good chance that Trump names a new Fed chair before Christmas. So Treasury Secretary Scott Bessent said Tuesday he expects President Donald Trump to make a decision on the new Federal Reserve chair by the holiday season. Trump has been a fierce Fed critic and recently said he'd love to fire Powell and encouraged Bessent to work on the chair to get the central bank to lower its key interest rate. So, again, Trump has been kind of playing this game with Powell for a number of months now, where he's been kind of dancing around saying, okay, I've got the person. I think I've got him. We're going to hire them soon. And, we've been seeing this hold. And I think that Jeremy has bought himself some time by doing these quarter-point rate cuts at the last 2 meetings. However, my guess is he doesn't cut the rate. Trump immediately comes out and just lays waste to him on X and True Social, and that basically he does, before the end of the year, he does name his replacement. That's going to be my guess here. And then we had this article here. So the Fed's Waller says he fits the bill for central bank leadership after his meeting with Bessent. So the meeting comes as Trump prepares to replace Jeremy Powell when his term as chairman expires in May of 2026. So Federal Reserve Governor Chris Waller said Monday that he recently met with Treasury Secretary Scott Bessent to discuss the nation's economic outlook amid growing speculation he could be chosen to lead the central bank. I talked to Scott about 10 days ago. We had a great meeting, Waller told Fox Business Network's Edward Lawrence. Waller added that the conversation was straight about economics and that his discussions with the administration have never been political. When asked what Bessent is seeking as he helps narrow President Donald Trump's list of a potential Federal Reserve chair, Waller said he believes they're looking for somebody with merit, experience, and a strong grasp of the job, and I think I fit that bill. Bessent, who has been interviewing candidates since Labor Day, has previously said that he wants to see people who are forward-looking, not backward-looking on regulation, gets the Fed chair job. So we'll see. We'll see what happens there with that. But Waller obviously is has his hat in the ring there and is looking to get there. Again, Waller's up there. Is he the front runner right now? No. And we'll see. We'll see what happens there. Kevin is still basically one of the Kevins is still the front runner right now. But Waller, again, he's trying to make his case. He's trying to go out there. Again, I haven't really been placed. I see this guy as a very how do I want to say it? I think he is very political. I think he is. I think again, he's trying to play all of his cards at the moment to try to get this job. I don't think this guy would be a particularly great Fed chief. Like I said, I think that the best Fed chief would be somebody who's probably not even on the list right now. That's my take on it. Like I said, I've seen the list of people, a lot of good people on there, but I don't believe that any of them fit the bill for what the Fed really needs right now, and that is the Fed. The Fed needs somebody that's going to go in there and is going to break up the groupthink that goes on at the Fed. So they need somebody that's going to go in there and basically, be somebody who's going to be a change agent, that's going to go in there and basically change a lot of the things, that's going to try to undo a lot of the things that, that have been so bad by the three amigos, by, Ben Bernanke, Jeremy Powell, and Janet Yellen, the three amigos. Basically what they have done at the Fed there over the last 16 years, 17 years has just been horrible. And I again, this will take time, but I do believe that I will be proven right over time in this statement, and that is, I believe that Powell, Janet Yellen, and Ben Bernanke were the three worst Fed chairs that we have had. And that they have done irreparable harm to our economy over the last 16, 17 years. And I believe that their tenure for all three of them, again, I believe that over the next 20, 30 years, as people get a chance to look back on this period, as people get a chance to examine it and write books about it, I do believe that unequivocally, they will basically go down as the three worst Fed chiefs that we have had. And when they look back on it, they're going to be like, man, these guys messed us up. They messed us up big time. So, and as I've said before, Trump cannot mess this pick up. He cannot mess it up. He has to get this pick right, because whoever it is, you're stuck with him. You're not going to be able to fire him. You're not going to be able to get rid of him. So you cannot mess this pick up. And so this is an extremely crucial pick. So, okay. And then I think this is the last Fed article that I have here. Basically, this is Fed governor says current economy is calling for large interest rate cuts to help the job market. So Stephen Miron warns current monetary policy is pushing unemployment rate upward. So yeah, I totally agree with Stephen Miron, but like I said just a couple of minutes ago, I do not think that Jeremy Powell is going to cut the rate in December. I think he's basically going to use the shutdown, the lack of some of the economic data here over the last couple of months as his big excuse, and he is going to cut that. So, either he's not going to cut that. He's basically going to say, nope, we're going to hold off until January and see what happens, and then go from there. So, all right. So that ends our Fed conversation for the minute. So now I want to talk AI for a couple of minutes here. I have about 5 articles here on AI, and this is looking at this AI issue from a number of different perspectives. So the first one we're going to look at here is how the U.S. economy became hooked on AI spending. Growth has been bolstered by data center investment and stock market wealth. A reversal could raise the risk of recession. Yes, just as I said at the beginning, I'm highly concerned with what is undoubtedly an AI bubble that has been developed. AI-related investment might have accounted for half of GDP growth in the first 6 months of the year. So the turbulence that hit stocks tied to artificial intelligence last week highlights a broader risk to the economy. growth has become so dependent on AI-related investment and wealth that if the boom turns out to bust, it could take the broader economy with it. Business investment in AI might have accounted for as much as half of the growth in gross domestic product adjusted for inflation in the first 6 months of the year. Raising AI stocks are also boosting household wealth, leading to more consumer spending, especially in recent months. It's certainly plausible that the economy would already be in a recession without the AI boom, says Peter Berezin, chief global strategist at BCA Research. Take away AI spending, and the economy looks in worse shape. Although job growth was higher than expected in September, job creation has nonetheless slowed this year, and the unemployment rate is inching up. Private business investment, excluding AI-related categories, is mostly flat since 2019, according to Deutsche Bank. Outside of data centers, other commercial construction, such as shopping centers or office buildings, is down. That makes the economy more dependent on AI. It's the only source of investment right now. So, and again here, AI-related investment boosts U.S. GDP growth. So, I mean, again, you could see that this, first quarter of 2025, second quarter of 2025, I mean, just a massive AI-related investment here. I mean, so so the GDP and the economy is really hinging on the AI investment at the moment. So, and then let's take a look at this. AI meets aggressive accounting at Meta's gigantic new data center. So favorable treatment of off-balance sheet hinges on some convenient assumptions. So this is the second aspect of this. So we have the economy is hooked on the AI spending, but now we're going to look at what are these AI companies doing. They're really stretching things here from an accounting perspective in order to make a lot of the numbers work here. So let's see here. So it seems like a marvel of financial engineering. Meta Platforms is building a $27 billion data center in Louisiana, financed with debt, and neither the data center nor the debt will be on its own balance sheet. That outcome looks too good to be true, and it probably is. Indeed, it is quintessential structured finance, the point of which is to help companies try to achieve seemingly irreconcilable financial reporting goals. Meta wants other people's money to pay for the data center. Those investors want to know Meta ultimately has their backs, but at the same time, Meta wants to keep its near pristine credit rating and doesn't want the extra assets and debt on its books. Construction on the project was well underway when Meta announced a new financing deal last month. Meta moved the project, called Hyperion, off its books into a new joint venture with investment manager Blue Owl Capital. Meta owns 20% and funds managed by Blue Owl own the other 80%. Last month, a holding company called Bignette Investor, which owns the Blue Owl portion, sold a then record $27.3 billion of bonds to investors, mostly to PIMCO. Meta said it won't be consolidating the joint venture, meaning the venture's assets and liabilities will remain off Meta's balance sheet. Instead, Meta will rent the data center for as long as 20 years, beginning in 2029, but it will start with a 4-year lease term with options to renew every 4 years. Now, a couple things I want to point out here. First Brands. We saw First Brands. They were a private credit company that blew up. Now, what was First Brands doing? Well, they had like 98 affiliate companies that they were basically pledging the same collateral to all those other 98 affiliate companies, and basically committing massive accounting fraud in doing so. And then taking out debt against all those affiliates. Okay, basically, so what's happening here? Oh, they created this joint venture, an affiliate, okay, and they're loading this over here. And who's involved with this? Blue Owl Capital, of course. Who's a major player in the private credit market? Oh, Blue Owl Capital. Let's take a look at something for Blue Owl Capital, shall we? Let's see here. Blue Owl Capital is considering reviving plans to merge two of its private credit funds if the share price of the larger fund improves, Reuters reported. The alternative asset manager is assessing its options after facing investor backlash against the move last week, according to the report. Yes, basically, they see a lot of losses coming on the horizon, so they were trying to merge these true private credit funds together. And in doing so would have incurred massive losses on those funds. And the investors said, yeah, no, you're not going to do that. And now they're saying, oh, well, yeah, the share price is improving a little bit, so we might be able to do this. So I want to point out to people here who Blue Owl is, okay, and what it is they do and how this smacks of exactly the same kind of stuff that's going on in the private credit market and exactly the kind of stuff that First Brands was doing. Now, I'm not trying to compare First Brands to Meta. I don't, again, I don't think that's an apples to apples comparison there by any stretch of the imagination. But there is a pattern of behavior. It's the pattern of behavior that you're seeing that is highly concerning. And I can guarantee you, if Meta is doing this, every other company is doing this. And this is also a big part of what you're seeing with Oracle. This is why Oracle stock was plunging down, because they were spending so much money on their capital expenditures, what's called CapEx, capital expenditures, they're to the moon over the next 5 years. And a lot of people are going, well, wait a minute, you're spending all this money, but and your revenue is up, but we're not seeing the kind of revenue that's going to be able to pay these bills. And thus that's why Oracle is underpriced. So again, I want to point out, now let's go to the next thing here. Sovereign AI takes off as countries seek to avoid over-reliance on superpowers. South Korea and others believe their homegrown tech sectors are strong enough to build up their AI capabilities. So, as China and the U.S. race to dominate artificial intelligence, countries are increasingly wary of becoming overly dependent on the superpowers for technology that could profoundly affect their economic competitiveness and national security. In response, a select few are seeking to build out their own AI capabilities and become leaders alongside the U.S. and China. South Korea, with its rich and advanced tech sector, is a strong believer in the idea that smaller countries can succeed in developing a wide degree of autonomy in AI, a buzzy concept known as sovereign AI. So in the age of artificial intelligence, falling behind by one day could mean falling behind by a whole generation. South Korean President Lee Jae-myung said earlier this month in an address to lawmakers, "We are currently facing an urgent life or death crisis. The overall goal of sovereign AI is to build out a localized computing infrastructure and potentially possess domestic capabilities in everything from large language model development and chip making to cloud storage and engineering talent. Many also hope to regulate and manage the data used and generated by AI on their own terms." As one of the few countries outside the US or China able to attempt a wide degree of AI autonomy, South Korea has emerged as a test case for what's known as sovereign AI. It has deep pockets, semiconductor know-how from homegrown firms like Samsung Electronics and SK Hynix, plus software expertise. And Lee, who took office in June, has provided the political willpower, pushing to triple the government's budget for AI development for next year to the equivalent of roughly $6.8 billion. So again, interesting side effect here, if you will, with this concept of sovereign AI. But I don't believe that this idea of sovereign AI stops simply with South Korea. I believe that the US and China will have their own level of sovereign AI. Undoubtedly, with all the spending that they're doing on AI, and all the building out of infrastructure, everything else, it's kind of hard to imagine that the U.S. government and the Chinese government will not have some level of their own sovereign AI, which undoubtedly they will. But again, interesting concept to point out. Flood of AI bonds adds pressure to markets. So prices of newly issued bonds have slid, adding to investors' anxieties about stock valuations. So Wall Street is straining to absorb a flood of new bonds from tech companies funding their artificial intelligence investments, adding to the recent pressure in markets. Since the start of September, so-called AI hyperscalers, Amazon, Alphabet, Meta, and Oracle have issued nearly 90 billion of investment-grade bonds, according to Dealogic, more than they had sold over the previous 40 months. AI data center developers like TeraWulf and Cipher Mining, both started as Bitcoin miners, also have stormed the speculative grade market, issuing more than 7 billion of those lower rated bonds. Companies were able to complete their sales, but some had to pay unexpectedly high interest rates. Prices of bonds from the companies have also been sliding, a sign that investors were caught off guard by the sheer quantity of bonds entering the market and of growing concern about the worsening credit metrics of the businesses. Stock investors already nervous about the sky-high valuations of AI businesses have taken note of the weakness in the bond market. Meanwhile, the cost of insuring those bonds using credit default swaps also has climbed, with negative sentiments from different groups of investors feeding into each other. So bond, and then a great chart here, bond issuance by big AI tech companies monthly, and you can see here up to almost $40 billion here in October, and it's just every month it's just, 18 billion. Almost 30 billion, and now we're up to almost $40 billion. Just amazing. And this isn't slowing down. This isn't slowing down. This is going to keep right on going. The markets are very interconnected now, said John Lloyd, global head of multi-sector credit at Janus Henderson Investors. It will be hard for credit markets to do well if AI stocks are selling off and vice versa. Investor enthusiasm around AI has been a powerful tailwind for markets in recent years, but the past few weeks have been tough, with the tech-heavy NASDAQ composite down 6.1% on the month. So if companies betting big on AI can make big profits, that would be good for their bonds. Still, the most that investors can get is regular interest payments plus their principal back at maturity. That makes bond investors especially attuned to the risk that outsized AI investments would live up to their hype. Even a ratings downgrade can hurt returns, let alone a default. So again, this is just very, very interesting here. So again, you're seeing here yield premium, long dated bonds. Oracle, no surprise there. Again, like I talked just a minute ago about their spending. Oracle's capital expenditures has been, just through the roof. So now they're trying to sell the bonds to fund all that spending. And, here it is. So they got their interest rates going up, yield premiums going up. So again, just another aspect of this to keep an eye on. And then finally here, this is another interesting sidebar. So again, the question becomes, we build all these data centers, right? And that's great. That's fantastic. We built all the data centers. How do we get the power to power the data centers to generate the AI, right? So can the U.S. make big nuclear reactors? Trump is betting $80 billion that the U.S. can revive the stalled nuclear power industry. So the U.S.'s last big nuclear power project came in more than $16 billion over budget and 7 years behind schedule. Now the U.S. government wants to give the AP1000 another shot. President Trump is betting $80 billion that the U.S. can revive the stalled nuclear power industry and make large reactors like the AP1000 from Westinghouse Electric, a ubiquitous power source rather than a cautionary tale. U.S. electricity demand is rising across the country, partly thanks to the frenzy over artificial intelligence after remaining flat for decades. Using some of the proceeds from its trade deal with Japan, the U.S. unveiled plans in October to partner with Westinghouse and its owners, Brookfield Asset Management and Cameco, on an ambitious plan to accelerate nuclear power. Executives at the companies now say they plan could translate into 8 AP1000 reactors across 4 sites, a pace of nuclear construction not seen in decades. The reactor produces about 1,100 megawatts of electricity, enough to power a mid-sized city or a major AI data center. Dan Sumner, Westinghouse's interim chief executive, said the reactors will help the U.S. win the AI race and achieve the president's energy dominance agenda. We're all in on the mission, Sumner said in an interview. We think it's very achievable. We have the right technology to do it, and it makes sense as the solution for the United States. Westinghouse estimates an overnight cost of roughly $10 billion per reactor, a sum that omits financing charges and assumes the plants could theoretically be built overnight. The arrangement could kickstart a technology that struggled to move beyond its troubled first U.S. builds. That is absolutely not true. The only API 1000 is finished domestically. 2 units at Georgia's plant Vogtle were originally expected to cost $14 billion, but ultimately exceeded $30 billion. They were meant to be completed in 2016 and 2017, but didn't come online until 2023 and 2024. Okay, I want to say a couple things on this here. Number one, the reason why that Georgia plant was such a problem was because the U.S. had not built a nuclear reactor in 40 years. And all those people, all those experts that were, that knew how to build a nuclear reactor were long gone. They had either died or retired, or, they weren't around no more. So Westinghouse literally had to go over to France. They had to bring in a bunch of engineers from France who at least had more recently built some nuclear power plants. So they had to bring in the French consultants, as it were, to help them basically, speed it up and get the thing. And obviously, so there was a major learning curve there, and basically, having to relearn how to build a nuclear power plant, and also trying to build it with updated technology. And one of the things that people never account for, it's ridiculous to say the technology has struggled to move beyond its trouble first U.S. builds. Like that is just such a BS statement. The technology has progressed immensely past that. I've been saying this for years, is that nuclear energy has become, the technology has accelerated. There is far better technology than what we were using 40, 50 years ago to build a nuclear power plant. So to make it a statement like that is absolutely ridiculous, and it just basically shows the bias of the author of this article here. To basically say, there's the technology isn't proven, it doesn't work, whatever. Like, no, it's proven and it works. Nuclear energy provides the cheapest form of energy. You can sit there and say, oh, well, yeah, but it contaminates. Yeah, the technology that we have today is better than it was decades ago. And if we invest the time in it, and I've always said that one of the big issues is there hasn't been the investment in the nuclear technology. If we had been putting the money like we should have over the last 4 decades into nuclear technology, that technology would be a million times better today, and we would be able to probably do an awful lot without the environmental pollution. We'd probably be able to make reactors much smaller that generated more power. But again, you're the environmental side of the equation. They want nothing to do with nuclear. They want to kill anything to do with nuclear, which I have always said is ridiculous. Is absolutely ridiculous. And so here we are today. And I do believe they got that learning curve out of their system. So when Westinghouse says, yes, we could deliver, 10 new power plants at $10 billion a pop, and we could do it fairly quickly, I think they can. I really do think they can now, because I think they did this Georgia project. I think they learned an awful lot from it. I think their engineers learned an awful lot from it, and now they have the know-how. They've been through the learning curve. And so and again, it's not one project. They're going to build 10 of these things. So they can, if you're going to build 10, obviously that's a lot more than one. I think you could spread the costs out more evenly across the board, and you could do it for a better price. So that would explain why they feel like they could get these things done at $10 billion a pop. So I'm all for it. Hey, build it out. Let's get it going. I not only would I like to see them build these 10, we've got a lot of nuclear power plants that are really aging and really old. I'd like to start to see a lot more money going back into refurbishing a lot of these power plants. I think a lot of the power plants have a useful life of something like 80 to 85 years, something like that. But you got a lot of power plants that are now pushing, I think, 40, 45, maybe even 50 years. So yeah, we definitely need to put money back into refurbishing a lot of these power plants. But okay, all right, that's my rant on that. So let's do what I usually do at this point in the show, and I talk about the 5 episodes that I put out this week, and then I also give you guys the economic indicators. Unfortunately, I have no economic indicators for next week. That's what happens over Thanksgiving. I went to look at the calendar. I was like, nothing for next week. So okay, so that was easy. All right, so let's get into the 5 episodes that I put out this week. Now, I'm gonna give a little disclaimer here for a minute. So, the episodes that I put out this week, I put these episodes out intentionally, and I put them out. They're a little different than the stuff I normally cover, because I intended for them to be more thought-provoking. I wanted people to think about these problems, right? So the first episode that I did was, do we have a problem with SNAP and American welfare. Like, due to the recent government shutdown, SNAP benefits in the American welfare state came into focus. Massive fraud in the SNAP program was unveiled. A deeper analysis shows a massive growth in the welfare state since the 1960s. It was recently announced that the SNAP recipients will have to reapply in an effort to crack down on fraud. What does the current state of the SNAP program and welfare in America really tell us about our economy, our politics, and where the U.S. is heading? So I covered a couple of articles there looking at some very interesting statistical information on SNAP and welfare. And it is without a doubt, our welfare state has become enormous. 47 million people currently on welfare. That includes 4 million able-bodied people that probably shouldn't be there. There's no doubt that if you got that many people and you got that much government money, that there's going to be a lot of waste, fraud, and abuse in the program, to be sure. You also have an issue with a lot of illegal immigrants getting on. How do they even get? How do they get on? How do they get on SNAP? How do they get on welfare? So I wanted to point this out because I wanted people to start thinking about, we should not have this, basically what has now become a permanent welfare state. Like, we should just not, we need to work very hard. I mean, this is, the taxpayers have to pay for this. Okay, the taxpayers have to fund this. There's no such thing as a free lunch. Okay, the taxpayers have to pay for this. So we have to start thinking very deeply about this issue. And I think people in this country really need to start thinking about, do we want this permanent welfare state that has been developed, or do we need to start working toward getting all these people off of welfare, or at least as many as we can? I'm all for a helping hand. I'm all for, hey, you fall on hard times. Somebody dies, you lose a job, maybe you got some kind of problem, alcoholism or something like that. You kind of fall on your butt, and now you need some help. I'm all for that, and I think we should have that. What I am not for is an able-bodied person who is able to go out and work, basically gets their welfare and just sits on welfare for the next 35 years. No, I'm not in favor of that. And then just keeps passing it to the next generation. That it becomes a lifestyle, basically. That's the problem. That's the big problem. So again, I put this out there so people would think about it. The next episode I did was, how we dress have an overall effect on society? So the way we dress conveys a message about how we see ourselves and others. Seeing people dressed up is becoming increasingly rare. At the same time, the clothes we wear speak volumes about us. In business, clothes are essential to how you appear to others, how you carry yourself, how other people view you, how seriously you are taken. In society, clothes give us many clues into the mental health of the country. So I think that, dressing appropriately is a very, very important thing, for not only for your work, but also for society at large. And I think that, the clothing trends that we see in our society over the last couple of decades here, I think are not good. And I'm not saying I want to go back to a time where everybody's just wearing a suit all day, every day. And I'm not necessarily saying I want to go back to that, but do we need to go back to a time when people are dressing nicer, putting more thought into the way they dress? I think that from a societal standpoint is a good thing. It's kind of funny. Sean Duffy was just out talking about, like, airports, and how, one of his things for trying to increase or make air travel better, he talked about the way that people dressed, and the fact that people come to airports looking like they had just rolled out of bed. He's not wrong, but he certainly wasn't right. And what I mean by that is the way people dress is not the problem with airlines. The TSA and the airlines themselves, how people are treated like just absolute cattle, and just pushed through the cattle chute. The collection of people's biometric information by TSA through their scanners, and taking DNA swabs of people and all the other stuff like that. That's the problem with air travel today, not necessarily how people are dressing. But his point, however, is I think should be well taken, and that is that yeah, I mean, people basically dress like slobs, and they do look like they just rolled out of bed. And and again, if I'm just traveling from A to B and I'm just going to be sleeping on a plane for 4 hours, like I mean, do I need to be dressed up to do that? I mean, probably not. But should I make a little bit more effort to look maybe a little bit better than just rolling in my jammies? Yeah, probably. So again, just again, thought provoking, some things for people to think about. Now on Wednesday, I did, will envy be the doom of capitalism? So envy is one of the 7 deadly sins. Envy is defined as the intense desire to have an item or quality that someone else possesses. Envy is at the very heart of socialism. The recent creep in the US towards socialism politically is very troubling. The US has been here before in the 1930s during the Great Depression. History has proven that socialism does not have the answers to economic problems that society seeks. Envy is a powerful vice, such as pride, greed, lust, gluttony, wrath, and sloth, the 7 deadly sins. In times of great economic turmoil, we all must be on guard not to be seduced by envy's siren song. So, again, I talk about this relationship of envy, one of the 7 deadly sins, being at the very heart of socialism, and how this creep towards socialism politically is a very troubling thing for this country. But not to lose hope, because we have been here before. This is not the first time that socialism has crept into the American experience. What I warn people about is that, communism is only one step from socialism. And you have to be very careful. We have to be very mindful. Envy is a very powerful thing. Get all the billionaires, steal from the rich, give to the poor. Unfortunately, it just, unlike the fairy tale of Robin Hood, it never works out like that in real life. Okay. Yeah, they steal from the rich and they give to themselves. Okay. The money never seems to find its way to the poor. um, and envy can be a very ugly thing. It can be a very ugly thing, and you have to be very careful not to give into the desire to want what others have. You have to be very careful about that in life. Okay, now on Thanksgiving, I basically just put out a bonus. I put out a strategy room bonus episode, just an update on mortgages and housing. It was a short little 6-minute video. So if you want that little update on housing, you can go check that out. And then finally, yesterday, I put out, our food system is in serious trouble. One farmer has a plan. So America's farm system is in trouble. Parts of it are collapsing in real time. Over regulation is crushing small farmers. An Idaho farmer named Steve Jarvis has a plan. It entails wiping out every farmer's debt. Very radical, but he might be onto something. Any bank or banker that is involved with agricultural lending should listen to this episode. If your state is highly dependent on agriculture, you should listen to this episode. So again, Steve has a very interesting plan there. But he also brings to light a very major problem, that we are facing a crisis in our food system itself. The food system itself is breaking down, and farmers can't make money. The big boys, the big conglomerates that have bought a lot of the farms across America, they can't make money anymore. So it's not an economy of scale issue, it's a system issue. And I think that we all need to pay a lot of attention to that, because, no food, no food equals a lot of massive, massive problems. So we don't want. So, okay. So those were the episodes that came out for this week. Next week, got a lot of great stuff coming up. Next week is going to be report week. So I got 5 banking reports that I'm covering. The San Francisco Federal Reserve Bank put out a working paper on tariffs. I'll be covering that on Monday. I'm doing a review of Bank Directors 2026, their annual bank M&A survey on Tuesday. Wednesday, I'm going to be reviewing CSBS, what is it? The Conference of State Banking Supervisors, CSBS. They completed a 10-year research project showing community banks pay more for compliance. So I'm covering that on Wednesday. Thursday is a review of 2024 CRA lending data. And then Friday, I'm doing a review of the October 2025 Federal Reserve Senior Loan Officer Opinion Survey, also known as the SLOOS. So those are the 5 reports that I'll be covering next week for Report Week. So make sure to check that out. And okay, and then I do have a little bit of banking news here for everybody this week. So the FHFA announces 2026 multifamily loan purchase caps. So the Federal Housing Finance Agency announced that the 2026 multifamily loan purchase caps for Fannie Mae and Freddie Mac will be $88 billion for each. FDIC announces a new chief of staff. So the FDIC announced the appointment of Dana Wade as deputy to the chairman and chief of staff. Wade will serve as advisor to the acting chairman, help manage the agency's day-to-day operations, and oversee the agency's divisions and offices. OCC to reduce BSA AML regulatory burden for community banks. Great news. The OCC announced supervisory and regulatory actions to reduce regulatory burdens for community banks related to the Bank Secrecy Act and anti-money laundering. Fantastic. I'm sure we'll have more details on that soon. Fed extends comment period for stress test proposal. So the Federal Reserve Board announced it will extend until February 21st the comment period on its proposal to stress testing of large banks. Rural Economic Index remains below growth neutral. So Creighton University's index of rural economic conditions increased in November to 44 from October's 34.6, but remained below the 50-point growth neutral reading. Consumer sentiment changed little in November. Pace wins the College Fed Challenge. So Pace University won the 22nd Annual National College Fed Challenge, a competition that encourages undergraduate students to learn about the U.S. economy, monetary policymaking, and the role of the Federal Reserve System. Harvard College took second place, UCLA won third, and the University of Pennsylvania, University of Chicago, and Davidson College received honorable mentions. So congratulations to Pace University there. FinCEN advises banks to follow AML CFT guidance. So the Financial Crimes Enforcement Network advised banks to follow the Financial Action Task Force updated lists of countries with strategic deficiencies in anti-money laundering, terrorist financing, and proliferation financing. So USDA announces updates to single-family housing guaranteed loan program. So the USDA announced updates to the single-family housing guaranteed loan program, which has resumed full operations. So, okay, that is the banking news that I have for everyone right now. So let us get back in. Let me switch up here for a second. Hang with me for 1 second there. Okay, let's get back to articles here. So let's get into some retail numbers here, shall we? Let's talk a little bit about what's going on here. So we got this report here that basically said slower U.S. September retail sales missed forecast, and there was also a couple new corporate bankruptcies or a couple new retail bankruptcies. U.S. retail and food services sales growth slowed in September and missed consensus expectations. So total retail and food services sales increased 0.2% month over month to $733.3 billion in September, according to seasonally adjusted advanced estimates from the U.S. Census Bureau. The data for September was initially due in October, but was delayed because of the U.S. government shutdown. Still, sales in September may have been flat from the previous month, rather than up 0.2% due to insufficient statistical evidence gathered during the period. And I just want to show you guys this chart here, and I am going to blow this up so that everybody can see this hopefully a little bit better. So September 25 retail store sales. Everybody can see this here. So the orange here, mainly to the right, is the year-over-year change. The green is the month-over-month change. Now, I just wanted to point this out that, you know, again, month-over-month might have been down a tad, but year-over-year, I mean, the numbers have been pretty good for just about every category. So again, I don't think this is any reason to majorly panic here with anything. And then we go over here to this. So I thought this was very interesting. A number of the articles that I was looking at leading into this week, leading up to Wednesday, were saying things like this. Shoppers curtail Black Friday plans to stretch spending. They are using every tool that they can, experts say. So, Black Friday is typically the biggest shopping event of the year, but several reports show a potential pullback in 2025. Many Americans are facing mounting challenges and an increasingly bifurcated consumer economy. Now, again, I don't necessarily dispute that. I mean, again, if we go back to the US debt clock for just a second, we could see here there is currently $1.3 trillion in U.S. credit card debt. It's obviously a problem. That's a lot of credit card debt out there for people. So again, I don't dispute that. However, this didn't make any sense to me. I was sitting there going, again, people. It's very interesting how every time you think it's going to stop or it's going to slow down, people find a way to keep spending money or keep spending money. And thus, on the next couple articles, I'm going to show you here. So, Black Friday online spending hits a record 11.8 billion as American shoppers embrace new AI technology. AI-driven traffic to retail websites jumped 805% as Americans avoided crowded stores. So, American shoppers turned to artificial intelligence in unprecedented numbers as Black Friday, helping push online spending to a record 11.8 billion as many consumers chose to avoid crowded stores and shop from home. So again, I wanted to point this out. Then the next one, Small Business Saturday poised for a powerful impact as SBA rallies Americans to shop local. SBA Administrator Loeffler says small businesses anticipate 20% of annual sales from Saturday alone. So again, today, for the Small Business Saturday, again, expecting a big pop. And we saw these record sales. Black Friday online spending hits a record 11.8 billion. As American shoppers. So this kind of going back to this for a second. Shoppers are going to curtail their Black Friday plans. Not so much. Actually, looks like they hit record numbers, and it looks like it's going to be just fine. So, but let's take a look at something else here. So, core wholesale prices rose less than expected in September. Retail sales gained. So the producer price index increased a seasonally adjusted 0.3% for September, in line with the Dow Jones consensus estimate. However, excluding food and energy, the index rose just 0.1% below the 0.2% estimate. Retail sales increased 0.2% in September, a bit softer than the 0.3% forecast. However, sales excluding autos rose 0.3% in line with estimates. So again, just for a second, if we go back to this chart, so again, what they're saying is that, sales sales were down a little bit, or sales again jumped a little bit in September, but weren't quite as high as what they were before. So again, people were looking at this for patterns, right? And they were looking at this to basically try to say, we're maybe seeing this little bit slowing in sales, and maybe this is going to translate into Black Friday not being so great. Not so much. Black Friday was fantastic, and we had record sales, and it was great. The producer price index, one of the inflationary numbers and indexes that we look at, came in, slightly below estimates. At least on the core aspect of it. Seasonally adjusted at 0.3% was right where expected again. But the key thing there being is that no increase in inflation. It stayed steady, and core actually decreased a little bit. And retail sales weren't super robust in September, but they weren't bad either. And it looks like the retail sales are going to be really good. So again, good stuff there. So just to recap there, while we did have slightly softer retail sales, and like I said, it looks like Black Friday and Small Business Saturday are going to come through big time, and sales are going to be very, very robust. And these economic data that we got in here on PPI and September retail sales, like I said, were pretty good. Not too bad. So, and then a couple other just kind of economic numbers that we had come in. So private payroll losses accelerated in the past 4 weeks, according to ADP. So private companies lost an average of 13,500 jobs a week over the past 4 weeks, ADP said, as part of a running update it has been providing. With the government shutdown still impacting data releases, alternative information like ADP's has been filling in the blanks on the economic picture. So the U.S. labor market is showing further signs of weakening as the pace of layoffs has picked up over the past 4 weeks. Payrolls processing firm ADP reported Tuesday. Private companies lost an average of 13,500 jobs a week over the past 4 weeks. ADP said as part of a running update it has been providing. That's an acceleration from the 2,500 jobs a week lost in the last update a week ago. With the government shutdown still impacting data releases, alternative information like ADP's has been filling in the blanks on the economic picture. Government agencies such as the Bureau of Labor Statistics and Economic Analysis have released revised schedules, but critical reports such as the monthly non-farm payroll count won't come out until December. So we'll have to keep an eye on this and see what happens. But obviously, if those numbers do in fact hold, that's not good because that does show a weakening of the labor market. But we will keep an eye on that. All right, another thing I'm keeping an eye on here, beef prices are close to record highs, but Americans aren't cutting back. So Americans spent over $40 billion on fresh beef in 2024, while drought and feed costs thin herds nationwide. So economists say the deep-rooted demand is helping drive prices higher, and there's still a sign there's little sign it will ease anytime soon. Glenn Tonsor, a professor of agriculture economics at Kansas State University, told Fox News Digital that strong consumer demand continues to push beef prices upward, regardless of supply fluctuations. There's nothing that forces me or you or anybody else when we go to the grocery store to pay more for beef. People are choosing to, he said. The consumer desire for beef is strong, and regardless of the supply side situation, that has the effect of pulling prices up. Yeah, people like beef. Shocking. This is in news stat. Most people like beef, and we'll like all kinds of beef. And beef is very healthy and nutritious for you, and it should be part of a balanced diet. So yeah, this just in. Shocking, right? I know. So a lot of people, yes, they're going to continue to buy beef, and they will continue to pay up for it, regardless of they'll cut back on other things and keep buying their beef. But I put this out there because obviously beef prices increases that's not good for the American consumer, and hopefully the things can be done to rectify this. Again, this gets back to the episode that I just talked about that I put out yesterday on the farming system. Again, go watch that episode. Watch what that farmer, Steve Jarvis, he explains exactly what's going on, exactly what is killing the farming ecosystem, if you will. And it is a major problem. And so I'm keeping an eye on this because this is a big part of it. This is a big part of what's going on. So so again, hopefully I would say over the next 6 months, hopefully this can be rectified, but we will see. Like I said, we'll keep an eye on it. This I thought was kind of an interesting side note here. New cash law could force Walmart and Costco to take your money the old-fashioned way. So legislation would require businesses to provide at least one point of sale location accepting cash. So yeah, so it turns out, as funny, interestingly enough, it turns out that when you take cash away, that hurts the poorest people. The poorest people do not have access to credit cards and debit cards and everything like that. They operate with cash. So you cannot take away their ability to pay with cash, which I think it's ridiculous that companies would be doing that in the first place. But that is what's happening. So Ohioans could soon be shopping like it's 1999 if legislators pass the currency access to spend here cash bill, which would require businesses and government offices to accept cash for payments up to $500. The bill would require businesses and government entities to provide at least one point of cash sale location that accepts cash. Additionally, it bans them from charging those using cash for a transaction a higher price than those using other payment methods. It's simple. Cash is the basis for business in America. Our taxpayers should always have the ability to use cash in their daily lives, said Ohio State Rep. David Thomas, who introduced House Bill 554. Yeah, I couldn't agree with David more on this. Yeah, cash is the basis for business in America, and taxpayers should always have the ability to use cash in their daily lives. 100%. Absolutely. I hear from residents who may not trust virtual payment options or just prefer to use physical cash. This bill balances the need of government and business to be efficient with the ability to still rely on physical currency. Yeah, the great thing about cash, you can't hack cash, and cash can't be tracked. Not like digital payments can. So again, I like cash. I love cash. I like using cash. And again, people shouldn't be, Target, Walmart, Costco, they shouldn't be preventing people from paying with cash. Okay, cash is legal tender, and not just them, but anybody, any company in this country that sells a product should accept cash as a viable payment. It is legal tender. It should be used to be able to buy or pay for anything. So okay, just thought that was interesting. We'll see what happens there with that, but just something interesting to point out. Um, okay, homeowners insurance costs could spike over the next 2 years. So insurance now accounts for 9% of a typical homeowner's payments, the highest on record. Yes, this is a big problem. So homeowners could see insurance premiums jump another 16% over the next 2 years due to an uptick in natural disasters and rebuilding costs. The average homeowner insurance premium is expected to rise 8% in 2026, followed by another 8% in 2027. Real estate analytics firm Totality projected at an annual real estate conference. Totality's chief data and analytics officer, John Rogers, explained that these premiums have been rising dramatically over the last few years, with some areas seeing double-digit growth. Rogers said that insurance now accounts for 9% of the typical U.S. homeowner's payment, which is the highest average on record of a person's outlay in terms of principal, interest, property tax, and insurance premiums. So yes, we absolutely have to keep an eye on this. This is going to become a real problem, I think, for a lot of people in a number of states. Obviously, property taxes continue to go up. Insurance continues to go up. Utility costs continue to go. Everything continues to go up. And this again, it adds to the affordability crisis in homes. It's not just the interest rate on your mortgage. It's all these other costs. The cost of the house goes up, but the cost of the insurance goes up. The taxes go up. The utilities go up. The cost of being able to just own, operate, maintain a house goes up, and it gets more and more challenging every year. But this is like I said, the home insurance issue is a big problem, and it's something we have to keep our eye on here. So, okay. A little bit of a private market update here for everybody for a minute. So investors clamor for a peek behind the private market curtain. So Wall Street wants to sell data on private markets where pensions and colleagues pay hefty fees and receive scant information. So Wall Street firms are acquiring private asset data providers, with the S&P Global buying with intelligence for $1.8 billion, and BlackRock acquiring Preqin for $3.2 billion. Selling data on private equity and private credit is becoming big business on Wall Street. In a market where opacity is the whole point, it is also a tricky feat. S&P Global last month became the latest Wall Street behemoth to shell out for a private asset data provider when it announced plans to buy with intelligence for $1.8 billion. BlackRock paid $3.2 billion for Preqin in March. MSCI acquired Burgiss for $900 million in 2023, and Morningstar nabbed PitchBook for $200 million in 2016. The drumbeat of acquisitions underscores how high precision private market data has become and how limited the information still is. Pensions, universities, endowments, and insurers now keep a lot of their money in long-term, hard-to-trade investments. But private asset management firms often keep basic insights about those assets under wraps. Information their clients take for granted in public markets, including what investments perform best or the makeup of common indexes, can be guarded as closely as state secrets. So it's frustrating to have this lack of detail, said Alaska State Fund investment chief Marcus Frampton, who could only guess at why his $15 billion private equity portfolio underperformed a widely used benchmark last fiscal year. He thinks it was biotech losses, but he's not totally sure. So U.S. state and local pension investment in private market assets, again, up to almost $1.4 trillion here in the last few years. That's becoming a little worrisome. I think that major investment there in, private equity, private market, yeah, that's a little troubling. That is a little troubling, but we'll see what happens here. Again, all these companies are buying up these smaller companies to try to be able to sell, keyword, they're being sell this data, to clients that obviously want to pay up to try to get better insights into what's going on inside of these various markets. So we'll see what happens with this. Okay, couple of things on Robinhood here. So traders are flooding markets with risky bets, and Robinhood's CEO is their cult hero. Brokerage co-founder Vlad Tenev makes exotic investments available to ordinary investors, seeing aggressive traders as key to the company's success. So Chief executive of Robinhood Markets took the stage at the online brokers annual summit in Las Vegas this fall, decked out in a race car driver's jumpsuit and customized Nikes. Vlad told the hundreds of cheering traders in the audience that they had chosen one of the most intense lifestyles out there. He compared trading to driving a race car. A finely tuned machine can make all the difference, he said, and that's the role we feel Robinhood plays for our active investors. Risk-taking is back for individual investors, and few people have done more to stoke those spirits than the 38-year-old Tenev. Robinhood's trading app makes it easy not just to buy and sell ordinary stocks, but to invest in options, cryptocurrencies, and other exotic financial products, even to make sports bets and play the prediction markets. The company's critics liken the environment to a casino, but its fans credit Robinhood with democratizing the lucrative world of sophisticated investments. He's almost built a cult, said Aaron Cook, a 28-year-old plumber who was in the audience in Las Vegas. Cook said he has used his profits from trading stocks, options, and meme coins to buy a Jeep Wrangler and a $60,000 home. A host of new products have entered retail investment markets in recent years and worked their way into the mainstream. Investors are wagering on the price of Bitcoin and piling into ultra-risky types of options, such as the zero-day variety that expire rapidly and require perfect timing. They are buying futures contracts tied to all sorts of events, betting on whether a Taylor Swift album will top the Spotify charts or whether the Green Bay Packers will beat the Detroit Lions on Thanksgiving Day. And again, I bring all this out to basically say that I have seen this movie before, and it does not end well. It does not end well. Basically, what happens is a lot of people get in, they start trading this stuff, and 99% of your retail investors out there are not going to make money trading. And I think, and again, there are reasons why the SEC has traditionally put kind of rules around certain types of investing and giving people certain access to certain things. And I think some of that has been there's again, we could have a long conversation about that. Some of that has been done, like, in other words, in order to basically to really get into like IPOs and private placement memorandums and things like that, you have to be what's called an accredited investor, and you have to meet the definition, the SEC's definition of what an accredited investor is. Now, and I think that it gets back to having an argument of, there are some people that would say that these kind of roadblocks and rules have been put in place to lock your everyday person out of the best investments. I think there's some truth to that. But the SEC would argue, in their defense, they would say, yeah, we are protecting unsophisticated investors against, from basically betting, gambling too much here, and basically getting into things and products of very sophisticated financial products that they really don't understand, and thus could lose all their money. So, that's kind of a very, I think it's a very nice way of basically saying that, oh, your typical retail consumer is pretty stupid, and we have to basically protect them from themselves. But there is truth to both sides of this argument. I think there are people that do not make money or do not have the annual income or the net worth that would meet the definition of an accredited investor. However, Does that mean that they don't have deep knowledge and breadth and understanding of the financial markets and finance and how these products work? No, of course not. Like, of course they do. Of course, there are people out there that have that understanding, but they're locked out. They're locked out of that market in a very real way. Now, in comes Robinhood and basically says, "Hey, we're going to give you all this stuff, and you could do all this or whatever." And that's great, but I have been one of those critics of Robinhood because I have knocked it because I do believe that they treat this more like a casino. I do believe they treat this more like gambling. I think it is painfully obvious that Robinhood has used something called gamification in their apps to make the trading like a video game. Make it, it's so cool, whatever. And it's designed to get you hooked on trading. This stuff does not happen by accident. They've put a lot of psychology into the app to make it the way that it is, to entice you, to bring you in. And again, and in some respects, like, yeah, they've been very successful. But I see problems with this because what is really happening here is that you're getting people. Like I said, I think you're getting more gamblers than investors, and you're getting people sucked into these things. And they're like, "Oh, hey, I could do a 0-day option, and I could make $200 or whatever." And they start doing it until they lose $200, and then they lose 1,000, and then it's like, "Oh man, I didn't have $1,000 to lose. Now I have a problem." And again, I've seen this movie before. I've seen this in years past. I've seen where moments in time when the retail investors really jump into they find something new. I mean, this happened in the early 2000s when digital trading first became a big thing, when you had, E-Trade and Ameritrade and all these different, online platforms. And what was it, Scott Trade and some of the other ones that were around back then. But again, people got into. I was in it. Hey, I was like, oh, hey, this is cool. This is great. I can go online. I can go to Ameritrade, boop, 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 hit some stuff and bang, and I make some trades online. This is great. Learned about options and everything, and so there was a lot of good to it. But like I said, but I also saw the bad to it too. I also saw how people got into it that really didn't know what they were doing and ended up losing their shirt. And it wasn't a good thing at the end of the day. So again, I want to point this out. And then here's the second article here. So Robinhood's latest prediction markets has its stock flying. So the retail brokerage is launching a new derivatives exchange in a bid to expand its prediction market offerings. Robinhood stock has more than tripled year to date, making it one of the top gainers in the S&P 500. So Robinhood's latest venture raises the prediction market's stakes. The U.S. brokerage made popular by offering slices of stocks to retail investors is launching a futures and derivatives exchange in a bid to expand its prediction markets business. Robinhood announced Tuesday that the exchange will be managed by a joint venture with the market maker Susquehanna International Group. Its shares were up 10% as of Wednesday afternoon, solidifying Robinhood's position among the top gainers with the benchmark S&P 500. Robinhood aims to be a one-stop shop for trading in stocks, crypto, and events contracts, as well as banking and mortgage services, while it faces fierce competition and rivals like Polymarket, which yesterday announced receiving a regulatory nod to resume U.S. operations. Robinhood could also attract partners that want to get into the events markets action, but don't have the infrastructure to do so. So again, very interesting. Robinhood just they're continuing to jump into different things. And on the one hand, I think, you have to applaud the fact that they are being cutting edge. They are, trying to give, in a certain respect, give customers what they want, give customers what they're looking for, adding new products, adding things that are, interesting. But like I said, it's the way that they're going about it. That's the thing I have the big problem with. And again, I would recommend to people, if you've never seen the movie Dumb Money, which just came out about a year or so ago, I actually reviewed it. If you want to go look at, I did an episode, I did a movie review on Dumb Money. Excellent movie, absolutely fantastic movie. But you have to see, Robinhood plays a prominent role in that movie. And you'll see, go watch the movie, see what they did to, all of a sudden, all those stunk stock customers, they basically turned off the feature, wouldn't let them sell their stock, caused a whole bunch of problems for a lot of people. And it was slimy. It was slimy and it was shady. And, our boy here was never, our boy Vlad here was never held to account for any of that. And I think that was a big problem that he was never held to account for that. But, so be it. So we'll keep an eye on Robinhood and see what happens from there. So, all right. Just a couple more articles here before we wrap up tonight. So the CFPB can't ignore the judge's order, as per the workers' union. So Trump-era officials can't use the borough's refusal to funding to force a shutdown. Plaintiffs argue the agency also issued a humiliating pledge for its supervision examiners. So the fight over the CFPB continues here. Again, I don't think at the end of the day, I don't think these union workers are going to be successful. I think the CFPB is going to get shut down, and it will happen in the next few months. And like I said, they could continue to argue all they want. I don't think it's going to do much to save the CFPB at the end of the day. And with that being said, let's look at open banking for a second. How the open banking rule skidded. The Consumer Financial Protection Bureau faces a budget crunch or closure in early 26, clouding the fate of its open banking rule revision. Yeah, I hate the open banking rule. I want the open. I've made no bones about it. I am an absolute do not like the open banking rule. Want it gone. And if the CFPB getting shut down kills the open banking rule, love it. Absolutely love it. But this just says here, the CFPB said this month it cannot draw funding to continue operations when its current funds lapse, presenting the agency a number of challenges in formulating an open banking rule quickly. The CFPB told a federal court on November 11th that the Justice Department had concluded that the Bureau cannot lawfully draw funds from the Federal Reserve System, which Congress designated as its funding source, and that the agency has funds to operate until year's end. The Bureau's notice did not specify what would happen then, although the CFPB's acting director, Russ Vought, has assailed the agency in the past and spoke publicly in October about its closure within months. The Bureau has been working on a new open banking rule since July, when it told a federal court it would substantially revise the rule, and was granted a litigation stay of a lawsuit filed last year by banking trade groups. The CFPB did not respond to an email Monday seeking comment on the rule. Last week, the Bureau notified employees that it would transfer its litigation work to the DOJ. It planned additional furloughs at year's end. In its motion for a stay, the Bureau told U.S. District Judge Danny Reeves it's planned an accelerated rulemaking process to address what it considered to be deficiencies with the prior rule enacted under the Biden administration. But any proposed rule with significant changes, such as allowing financial institutions to charge fees or access customer data, would also require the Bureau to assess the impacts to small businesses under the federal Small Business Regulatory Enforcement Fairness Act, attorneys noted. At that point, a public comment period on the proposed rule, typically 30 to 90 days, would begin. The CFPB would then consider those comments and issue a final rule. However, the Bureau is considering skipping some parts of the rulemaking process to issue a rule by year's end, potentially including a public comment period on its proposed rule. Bloomberg Law reported Thursday, citing multiple people familiar with the matter. Given the polarized view of these rules by the banking and fintech sectors, if either constituency objects to the substance of the CFPB's revisions, additional litigation could ensue. An attorney with law firm McGlinchey Stafford, Adam Mayrek, wrote in a September alert about the process. So again, we'll keep an eye on this and we'll see what happens here over the next month or so. But again, I, for one, am not rooting for the open banking rule. Okay, FDIC, OCC, Fed, and they solidifying the ESLR changes. So regulators finalized a rule-cutting capital requirements for the nation's biggest banks, proposed a separate trim for community lenders. So that was good news there. Vault Bank applies for de novo charter. So former U.S. Bank executive Mac Gettiman said the de novo's model is designed to support small to medium-sized businesses by making banking uncomplicated, accessible, and integrated with digital tools. So we shall see what happens there with that. Comerica Fifth Third sued by activist investor. So Holdco accused Comerica CEO of being focused solely on advancing his own interest based on the rushed way the bank's proposed deal with Fifth Third came together. Well, it was Holdco that basically forced Comerica CEO to basically go to sell the bank. So, I mean, I don't know what they're complaining about. But interestingly enough, I thought it was very apropos that I did an episode on activist investors and what that means for your board of directors. So if you have kind of interest on that topic, go check out that episode that I did on that. Green Dot inks deals splitting bank and fintech business. So the company, which has been exploring strategic alternatives since March, will sell its fintech business to a private equity firm and its bank to an $840 million asset lender. So interesting news there. And then finally, Fulton Bank to buy New Jersey's Blue Foundry, a $243 million deal. The deal comes 18 months after Fulton acquired failed Republic First Bank's assets, which gave the Pennsylvania-based lender several Garden State locations. So again, Fulton on the move and continuing to add to their bank. So good for them. So, okay. All right, well, I'm going to go into a wrap-up mode here. So before we get to our story of the week and our quote of the week, I'm just going to go over a couple items I like to touch on here at the end of the live stream. So if you listen to the podcast on Apple Podcast or Spotify, please leave me a review. I definitely need those reviews. They really help out. Oh, you know what I need to do? I need to get my banners. Okay, so first banner up. So please visit thebankernextdoor.com. Got a lot of great stuff on the website. You can find all the episodes. Everything is on there. Got a lot of new features and things that'll be coming soon to the website. But yeah, go onto the website, check that out. Make sure to subscribe on YouTube if you want to get the latest updates via post. I usually put out posts for like all the episodes that are coming out this week. I also try to let people know like what I'm going to be covering in the live stream for that week and things like that. So if you want the latest updates and just like kind of news from the channel, make sure to subscribe on YouTube for that. Send comments, questions, or topic recommendations to info@The Banker Next Door. That's how you get a hold of me. Email me at info@The Next Door, again, for comments, questions, or any topic recommendations. Make sure to follow me on social media. You can follow me on Getter, X, and Truth Social, although I will say I spend the majority of time on X. You can follow me on there. Just remember, BND is on YouTube, Rumble, and all major podcast platforms. New episodes every week, Monday through Friday, premiering at noon, and the BND live stream every Saturday night here on YouTube at 8 o'clock. So those are my little tidbits there to share with everybody. Okay, let's go to our story of the week. So this week we're going to do market sentiment. So market sentiment refers to the overall attitude of investors toward a particular security or financial market. It is the feeling or tone of a market or its crowd psychology as revealed through the activity and price movement of the securities traded in that market. In broad terms, rising prices indicate bullish market sentiment, while falling prices indicate bearish sentiment. When bears are in control, stock prices are going down. When bulls are in control, stock prices are going up. Emotion often drives the stock market, so market sentiment is not always synonymous with fundamental value. That is, market sentiment is about feelings and emotions, whereas fundamental value is about business performance. So market sentiment is our story of the week. Now let's go to our quote of the week, shall we? Okay. One of my favorites, this just comes from Proverbs, and it basically states, a good name is to be desired above all else. That is from Proverbs. I think that is fundamental in life. You must always strive to maintain a good name. A good name is desired above all else, and it is fundamental to everything in life. It's fundamental to your success, fundamental to your happiness, just everything that happens to you goes along with a good name. So do everything you can to protect your good name and to grow it. So, okay. That being said, that's all I got for everybody tonight. I hope everybody had a wonderful Thanksgiving. I hope everybody has safe travels as they travel back home, probably tomorrow. And just be safe out there. Safe travels, get home safe. I hope everyone had a great week. And like I said, don't forget, this week is report week, covering a lot of reports and information that have come out in the banking world here over the last couple weeks. Make sure to check all those episodes out. And I will see you guys again next week. Same time, same channel here on YouTube at 8 o'clock. Until that next time, we'll be back in the strategy room next week. Have a great weekend, everybody. Take care.